Hello traders, this is Fawad Razakzada, market analyst for City Index. Today is the 5th of June 2024. So we are approaching the business end of the week and we have some key economic data releases to look forward to, starting with the ADP private payrolls coming up shortly. But more to the point, we have the ISM services PMI later on in the day. Tomorrow we have the unemployment claims and followed by the jobs report on Friday. As you can see, there are a couple of central bank meetings as well. The Bank of Canada is expected to cut rates by 25 basis points, and so is the ECB, who are meeting tomorrow. We also have the Canadian jobs report on Friday as well, making it a very important week for the Canadian dollar. So the dollar CAD is going to move sharply on the back of these macroeconomic announcements, and currently rates are consolidating as indicated, for example, by price oscillating around the flattening 21-day exponential moving average. Key support to watch is at 136, which was resistance in the past. This level needs to hold for the long-term bullish trend to remain intact. If we were to go below this level on a daily closing basis, I think that would be bearish, particularly if this level right here at 135.47, which was the low on this particular day prior to the rally that took place in the second week of April took place. So if we go below that level, I think that would point to the end of the bullish trend. So that's the line in the sand for me. In terms of resistance, 137.35 has been tested on a number of occasions, as you can see, in recent trade, and so far it has held. So from a bullish point of view, we will need to see a break, ideally on a closing basis, above that area to signal the resumption of the bullish trend. Now, looking at the dollar index, you can see that it has broken its bullish trend line. However, it's yet to make a lower low beneath the low that was hit in April at 103.88. That level is now the line in the sand insofar as the dollar index is concerned. If we have more weakness in economic data from the US, remember we had a very weak ISM manufacturing PMI on Monday, followed by job openings data that came out on Tuesday, which also disappointed expectations. So if we see further weakness in US data, I think that's going to put a rate cut before September back on the table, and that may well send the dollar tumbling below the April low at 103.88 and therefore create a bearish price structure. So far we haven't had a lower low, but that could change this week depending on the outcome of the data. So a couple of levels to watch. I mentioned 103.88, which is the line in the sun, and so far as the bullish trend is concerned. On the upside, this level right here at 104.50-ish is where we also have the backside of the trend line that had been in place since December coming into play. If I zoom in, you can see that the 200-day moving average comes in at around 104.40-ish area. So basically the area around the 200-day moving average to around this zone is where the key resistance zone lies. We have a number of technical indicators converging there, as well as the price support. We have the backside of this broken trend line and the 200-day moving average. So it needs to close above this area in order to signal the resumption of the bullish trend. One way or another, this week we will find out which direction the dollar is likely to head to in so far as the short term is concerned, and a lot will depend on the jobs report that will be published on Friday. Economists expect a reading of 186,000 versus 175,000 the month before. Don't forget the average hourly earnings, which is a measure of wages and therefore inflation. This is expected to come in at 0.3% month over month. And finally, the unemployment rate is expected to remain unchanged at 3.9%. Now, for more market insights and analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.